What's up, guys? This is Manoj Vaptani. I welcome you all on behalf of the ADPDA world. It's been a fantastic morning outside, and I'm sure that you guys must be enjoying your life to the fullest, guys. And certainly, you guys must be honoring your word, a word that you gave me right at the inception of the video presentations, and that was relating towards your regular and recurring revisions. I hope you guys are not escaping them up. Don't skip your revisions, guys. That is something which is extremely important for you. So, this is going to be the eighth video presentation relating to the topic of foreign exchange. By now, we have already covered our 7 video presentations in which I've discussed with you a lot many topics. Still, there are a few more topics which needs to be covered. Okay, I have prepared 8th video presentation, plus I'm going to prepare the 9th video presentation wherein I'll be covering a lot more topics which are remaining and which are required to be completed from my end. Post that, I'll be discussing with you the kind of questions that have already been asked in CA final examinations in previous attempts. So kindly stay tuned with Edipedia World. A lot of activities are going to happen with respect to this particular chapter, and this is one of that most important kind of a chapter wherein maximum number of marks questions are being asked in the CA final examinations. There are times when the students usually find the maximum weightage of the CA final examination with respect to the subject of SFM. Most importantly, foreign exchange is one such topic which sometimes cover even 30% or 40% of your examination. Whereas in some of the attempts, it may vary from 10% to 15-20%. But normally the average is 10 to 15 of 20%. Okay. But sometimes the examiner is pretty much happy with this particular topic, and a lot many questions are being asked from foreign exchange. So do not skip your revisions. Try to retain each and every kind of topic that I make you understand while discussing the relevant topics relating to this chapter. Okay, I keep reiterating you with this particular thing that you need to go for your revisions at regular and recurring intervals. So don't skip on that. Okay, this is going to be the 8th video presentation. Shall we just proceed with the first topic of the day? Fasten up your seatbelts. We are about to take off with the first topic, and that will be relating to options and futures. Guys, in my last particular presentation, I did mention to you something relating to options. What does option basically mean? How to go about taking up the call options, put options. I also discussed paths relating to futures. What is future? What do we need to do in order to undertake the future contracts? This is basically a tabular presentation wherein I'm going to discuss with you what is the basic difference between options and future. Now, let me mark the beginning with the first point. Options basically provides you a right. Okay, option is something, as the name suggesting you, it is a kind of an option. Option is basically the right. Okay, only the seller in this particular thing is obliged to perform. Okay, if you are a buyer and you have gone for an option, buying of an option, you are not obliged to perform. Okay, you have got the right, not the obligation. Why? Because you have bought that option. So technically, only the seller is obliged to perform. If in case, let's say today the market rate is 50 rupees per dollar. You went for an option of buying, let's say 52 rupees for a single dollar. And somehow, while the scenario turned out to be on that particular day when you were actually supposed to buy that currency, okay, the market rate was going on at rupees 49. So now, are you supposed to buy that currency for 52 rupees per dollar? No. You got an option over here. Okay, you are the buyer. You have paid the seller the premium, requisite amount of premium. So technically, you are not supposed to buy it at a higher rate because you have got a right, not the obligation. So you can simply go into the market and can take that particular currency for 49 rupees and can leave from this contract, that is your option, by simply paying the option premium. That's it. So technically, only the seller is obliged to perform. In case of futures, both the parties are obligated to perform. No party can deny entering into the contract later on because future is something which doesn't provide one single party a right and the other party an obligation. No, future is something which provides, which lands up both the parties in a position wherein they are obligated to perform. That is what futures is all about. The rate may be anything. It may be 50, 52, 54, anything. The buyer has to perform, that is, the buyer has to purchase the currency, and the seller is supposed to sell the currency. None of them can deny in it. So this is the difference between option and future. That is number one. Number two comes in, premium is paid by the buyer to the seller. As I just made you understand with my last example, option is something which provides you the right of taking part into that contract. Okay. So since you are getting a right, certainly in this particular world, you're not going to have even a cup of tea without paying. Okay. So how can you expect that you'll be getting a right without paying something? Absolutely not. So certainly you are supposed to pay some kind of premium. That premium is gonna be paid by the buyer to the seller. Why? Because seller is the one who is obligated to perform. He doesn't have any kind of right. If in case tomorrow something doesn't happen in his favor, still he or she has to undergo that particular transaction. Why? Because they are obligated to perform. And in consideration of that obligation, they accept some certain premium from your end. That is the buyer's end. So premium is paid by the buyer to the seller in case of options. Whereas in case of futures, there is no premium. No premium is paid by any party because both the parties are obligated to perform. Simple guys? Cool. Then the third point says loss is restricted while there is unlimited gain potential for the option buyer. Let me tell you with an example. Supposedly, the spot currency going into the market is 50 rupees for single dollar. You just went for a trader, okay, trading position. You want some kind of US dollars in your pocket later at, let's say, after a period of 2 months. You just contacted a foreign exchange dealer and you asked them, I want to go for an option, okay, which is I'll be taking up your single dollar for 53 rupees 3 months forward, okay. He agreed to it, okay, and in consideration he basically asked you for some amount of premium, okay. He basically told you up, okay, I'll be providing you this particular option, but I'll be charging you 1 rupee per dollar as your option premium. You said, okay, cool. So now if tomorrow the rate goes till, let's say, rupees 65 rupees for per dollar, okay, now the market rate after 3 months is 65 rupees per dollar. You entered into the contract with that particular trader for 53 rupees. So which is gonna be the market wherein you'll be purchasing it? Obviously wherein you are getting that particular currency for lesser amount of money. So you'll be purchasing that currency from that trader for 53 rupees, okay, and you will be going into the market and definitely you'll be like, okay, I can now sell this currency into the market for rupees 65. So what's the harm in it? You'll be going into the market and you'll be selling it for 65 rupees. 65 minus 53, you'll be gaining 12 rupees out of it, okay. However, against that gain of 12 rupees, what was that cost? That cost was simple, the option premium of rupees 1. Still you managed to make up a gain for rupees 11. Is it a bad deal? Certainly not. It's a very good deal for you, okay. But now let's go ahead, because this particular thing which I told you, that is something relating to your unlimited gain potential. It can go as much as it can, okay. But coming to the second point, which is the loss is restricted. Let's suppose the call after a 3 months period is only, let's say, the market rate which is going on in the market is 49 rupees per dollar, okay. You agreed to buy that particular currency for 52 rupees from that trader from 3 months forward, okay. So which market will you be like preferring to buy that currency? Is it gonna be from directly trader or is it gonna be from the market? Obviously you'll be procuring that currency from the market. Why? Because the market is offering you that currency at a lesser amount of money, which is 49 rupees per dollar. So what will be your loss in this particular transaction? Nothing but your option premium that you paid to him. That was rupees 1 per dollar. So by this particular example, I made you understand that your loss is going to be very much restricted, and that loss will be restricted to only your option premium. But if in case you land up in a good position and the exchange rate turns out in favor of you, then there is the unlimited gain potential for the option buyer. That is what third point in case of option states. Whereas if I'll compare the same situation with the future, there is a potential risk for unlimited gain or loss for the future buyer. So it can be a situation wherein the seller might be the person who will be like, who ends up earning good amount of money, and you being on the lesser amount of money, you'll have to shed that money from your pocket, okay. You'll be at the losing end. At the same time, there is a very good possibility that if the exchange rate goes in your favor, then you being the buyer of that particular currency, you may end up earning good amount of money, and the seller will be shedding the amount from his pocket. So there is an equal potential risk for unlimited gain or loss for the future buyer. So since you are obligated to perform in future, you cannot deny at a later stage of time. Okay, that is what the difference between option and future is. Lastly, the option contract can be exercised at any point of time during its period by the buyer. It is between those two persons, and certainly it can be exercised at any point of time during its period by the buyer. Okay, he may ask you for like 2 months forward, 3 months forward, or maybe like 4 months forward, that way. So it can be exercised at any point of time during its period by the buyer. However, in case of future contract has to be honored by both the parties only on a specific date. Most likely that specific date is usually the last Thursday of the month. That is what goes on into the market. Okay, usually that date ranges from 26 to 28, keeping in mind which Thursday is it coming on. Okay, so that these particular four are the major differences between the options and the futures. I hope I made you understand each and every point with a particular example so that you guys can get a particular and a better understanding with each point that I made you understand over here. Shall we proceed further, guys? Let's go ahead with the next topic. And this is gonna be this. What techniques, what strategies should be made if in case the market is bullish or the market is bearish? What all should be done from your end if in case you are a call buyer, you are a put seller, or you're going for a long future position, or you are a call seller, put buyer, or you're going for a short future position? This is one thing which will help you in developing that practical knowledge while you are going into the market. Okay, whatever thing which I am making you understand with this particular presentations, this is certainly not restricted to your CA final examination. Okay, foreign exchange is one such topic wherein you can actually go into the market and get the best of your benefit while exchanging the currencies, guys. Remember, in the first video itself I told you there are many currency exchanges. Okay, you can go ahead with iForex, uForex. There are many currency exchanges which are going into the market. Okay, all these things are online available. Platform is available online. You just need to have that 5,000 rupees in your pocket. Okay, and you can start anywhere around. Okay, that is something which is the minimum requisite amount of money which is usually taken up from the exchanges in order to protect the interest of all the investors. And you can go ahead with any of the position relating to your arbitraging, trading, anything related to currency market. Okay, this is going to be one thing which will help you in developing your understanding as to what you should do if in case the market is going up or the market is going down. Okay, this is something which I'll tell you with each and everything over here. Okay, now guys, number one thing, what is bullish position, what is bearish position? Okay, let's understand that first of all. Bullish, as the name is suggesting, what do bull do? Okay, have you ever seen a normal bull? Okay, bull is basically a symbol of aggressiveness. Okay, go into your nearby areas, go and roam around in your vicinity, and you will see that normally the behavior of a bull is basically very aggressive. Okay, on top of it, being aggressive basically directly inclines to one symbol, which is that the market is going up. Okay, aggressive market, everybody is facing forward, everything is going up. That is the bullish position. If I'll compare it with a bear position, bear is something a kind of an animal, okay, who is very lazy. Okay, at most times, if in case you are not disturbing a bear, definitely, then at most likely events, bear is one such animal who's gonna be very lazy, and it's a very calm kind of animal. Okay, having said that, you don't just disturb a bear. Okay, he is gonna be very, very, very aggressive. If in case you'll be disturbing him up, definitely. If in case you have never watched a bear getting aggressive, just watch the movie for which Leonardo DiCaprio won the Oscar. That is Revenant, and you'll get to know. Okay, a bear actually made his survival completely miserable in that movie. Okay, So bearish position is primarily a one which indicates slow movements. Okay. So bearish market is the one wherein the market is declining. Okay. That is the difference between the two. Bullish position basically means the price is rising, resulting into a gain. Okay. Bearish position is the one wherein price is falling. So what steps do you need to take or incorporate in order to ensure that you don't lose out on your money? Okay, you finally get some gains out of it. Okay, now the price movement in my next line is price movement, then call buyer, put seller and long future in bullish position, call seller, put buyer, short futures in bearish position. Let's mark the beginning with the first one, that is the price rises. What if the price is rising? Okay, the market started at, let's say, 50 rupees per dollar. Okay, now the market is rising. Okay, it's going on 51 rupees per dollar, 52 rupees per dollar, 53 rupees per dollar. Okay, now what you should do as a call buyer? Okay, if you are basically going for a call, okay, and you're buying it, call basically will be like, I'll be buying this particular currency, let's say for 51 rupees per dollar. Okay, today the market rate is going on for 50 rupees. I am purchasing this currency for 51 rupees. Okay, but still the market is going up. It's going up and up. So what's your potential in this particular case? It's going to be unlimited gain. Let's say after a period of 3 months, the strike price strike to, like, let's say 65 rupees per dollar. So definitely the gain is unlimited if in case you are going for a call position as a buyer. Now coming to the second point, which is the put seller. Okay, what if you are a put seller? Put seller means you are basically selling an option for the other person to sell his currency at a fixed amount of money. Okay, now since you are a seller, you'll be obtaining a premium, that is the option premium. So since the market is going up and he has been asked to sell his currency, let's say for rupees 54, and tomorrow the rate turns out to be, let's say, 60 rupees per dollar, will he be like convinced to sell you that particular currency for 54 rupees? Absolutely not. He can directly go into the market and sell his currency for 60 rupees. Then why would he actually provide you his currency for rupees 54? Definitely not. But having said that, you in this particular situation as a seller, you will be getting a limited gain. Okay, you will still be able to manage some limited gain out of it, which is your option premium that you'll be receiving from that buyer. So your gain is limited if in case price is rising and you are a put seller. Number three comes in to be long futures. Okay, long means buying. Okay, and future means what's gonna be happening as your position if in case you buy that currency today. Okay, the spot market is providing me a rate of, let's say, 50 rupees per dollar. Considering the long futures, I buy that currency for, let's say, 52 rupees. And after a point of time, it shoots up till 60 rupees per dollar. So what happens to my gain? My gain is going to be unlimited in this particular case as well. Why? Because I've already bought this currency for a cheaper amount of money and today it's skyrocketing. Okay. That is going to be the case in case of long futures, unlimited gain. I hope I'm clear, loud and clear till this point. Okay, call buyer, put seller, long futures. Clear, guys? Let's go ahead with the call seller part. Okay, what if the position, I'll be covering this particular presentation in the horizontal manner, not the vertical one. Okay, so I'll be covering the price rises first, price movement for both the positions, that is bullish and bearish, then price falls and then price unchanged, so that you can get the overall idea for both the positions simultaneously. First point is the price rises. So the price movement is price rises. Okay, what if the price is rising? Okay, now the position is 60 rupees per dollar. Okay, now since you are a seller, okay, you actually land up in a position for providing that particular currency to that buyer for rupees 54. Okay, you obtained a particular option premium which is rupees 2. Now since the price shoot up till 60 rupees per dollar, what will be the better position for that particular guy who is gonna buy your currency? Will he be like purchasing that currency from you at rupees 54 or from the market at 60? Obviously, he'll be purchasing that currency from your end. You'll have to sell that currency to him at 54. And the loss for you will be like you'll be obtaining that currency from the market for rupees 60 and you'll be selling that particular currency to the buyer for rupees 54. So your loss is gonna be 6 rupees. That is something which is just in this particular case. If in case the market rate would have been like shooted up till 70 rupees per dollar, what would have happened? You would have incurred a loss of 16 rupees minus 2 rupees premium, 14 rupees. So what's going to happen in your case is, as a call seller, you'll have to bear an unlimited loss, okay? If in case prices shoots up, that is rises. What if in the second scenario, coming to the put buyer, okay? Now you have actually gone for a position of selling that particular currency at a fixed amount and you have bought that option. So since you have bought that option, you are supposed to pay a premium. Okay. You have paid now the premium of rupees 2. Now since the prices are rising, okay, and since you are a put buyer, okay, you did entered into a contract with that person that you'll be selling that particular currency for rupees 54. The spot rate is 50. You'll be selling that particular currency to that seller to the buyer, basically to the buyer, and you bought this option. So you'll be like selling that particular currency to them for rupees 54. And what if the prices have actually touched 70 rupees in the market? So will you be like selling that particular currency to him or in the market? Obviously in the market. Why? Because you'll be fetching up good amount of money from the market, that is 70 rupees per dollar. So what will be your loss in this particular case? That will be limited to only the option premium that you have paid. So your loss is going to be limited only to option premium in case of put buyer, if in case the prices are rising. Lastly, I'll talk about the short futures. Okay, short futures is a one wherein you'll be selling out that currency. Okay, you'll be selling out that currency future. So it's gonna be the unlimited loss. Why? Because you have short the position. You have actually sold your futures. Okay, the spot rate is 50. You sold your futures for 52. Okay, now the thing is the price actually shoot up later on and it went till 70. Had it been the case, you wouldn't have sold your currency at 52 and you would have kept your currency in your hands. You would have been into a position where you could have sold your currency for 70 rupees and rather than merely going for 52 rupees. So again, it's going to be unlimited loss to you in case of short futures for price rises. I hope all these 6 transactions are pretty much clear to you in case the price rise happens. The adverse, like completely opposite thing happens if in case the prices falls. Okay, in case if the price falls, okay, from 50 it goes to 40. Okay, and let's say you entered into a transaction for each one of them at 52 rupees. Okay, so since you're a call buyer, you agreed to buy that particular currency for 52 rupees for 1 rupee premium. Now since you are available, that particular currency is available to you in the market for 40 rupees. Where will you go to purchase that? Obviously to the market. So what did you lose in this particular transaction? As a call buyer, you just lost your premium, that is rupees 1. So your loss was limited in it. In case of put seller, now you're a seller. Okay, since you're a seller, you'll be obtaining some amount of money as premium now. Okay, since you are a seller, the buyer is gonna pay you premium amount. Premium again 1 rupee. Now the price has actually fallen. Now where will that particular person go since you are a put seller? Okay. Now he has agreed to sell you this currency at 52 rupees. Now the market is providing them the rate of 40. Where will that person be selling his currency? To you or the market? Market is gonna provide him only 40 rupees. He has agreed to sell you that currency for 52. Obviously he'll be selling it to you. Why? Because he'll be getting a gain of that 12 rupees from your end. So what's your loss? Your loss is going to be unlimited in this case. You've actually went in for a position wherein you have received only the option premium, that is rupees 1, and against it you'll have to undertake unlimited loss if in case the prices falls. Coming to the third point, which is the long futures. Okay, if in case the position is for long future, what's going to happen in this case is, if the prices falls, then since you have bought the position, okay, long means bought the position, you have bought the position for 52 rupees, currency exchange rate falls down to 40 rupees. So since you bought it for 52, had it been the case, you would have waited, okay, you would have received that currency for 40 rupees from the market directly without incurring those 12 extra rupees from your pocket. So again, your loss is gonna be unlimited in this particular case, since it may be like the exchange rate on the final day may fall till 32. So it's gonna be unlimited loss for you. Okay, in case of long futures. Coming to call seller part, bearish position, that is the price is gonna be falling. Okay, since you are a call seller now, that means you have actually provided the person, that buyer, a right to buy your currency at a particular amount. Okay, since you are a seller, you'll be receiving the premium for his side. Okay. So let's say the premium is rupees 1. The call strike price that you have offered to him is 52 rupees. And now the prices have fallen. Okay. Let's say till 40 rupees. Okay. So where will that person go? That person will directly go into the market and procure that currency at 40 rupees rather than going at your end, coming at your end and obtaining the same for 52. Okay. So what was your gain out of it? You just received a limited gain, which is the option premium. That is going to be the case in case of call seller. Lastly, next comes in the put buyer. What happens in case of put buyer and if in case the prices are falling? In case of put buyer, if I'll tell you, you are a buyer in this situation. Okay, that simply means that you'll have to incur and you'll have to pay the premium. Okay, now after paying that premium, what are you getting as a consideration? So you are getting a right, which is you can sell that particular currency at a fixed strike price to that person. Okay, so now let's suppose that fixed price is 52 rupees. Okay, you have paid the premium of rupees 1. The current spot price is 50. 52 was a strike price for your end, and let's say the currency actually fall till 40 rupees. Okay, now since you were supposed to sell him that particular currency for 52, now what will you do if in case the market is offering you 40 rupees for your currency? Will you be like selling into the market or to him? Obviously to him. Why? Because that person is going to be like paying you 52 rupees, whereas the market will only pay you 40 rupees. So what's going to be your gain if in case you are a put buyer? Your gain is going to be unlimited. Simple, guys. And lastly, short futures. In case of short futures, if you're going for short futures, since short is basically the selling part, you agreed to sell that particular currency for 52 rupees to him. Okay, now the market actually started falling, and somehow after 2 months, the price actually did fall to 40 rupees into the market. So what's your gain in it? You sold that particular currency for 52 rupees. However, if in case you would have waited, the same currency would have been sold from your end for 40 rupees. So basically, while not delaying and by shorting your futures, okay, you basically ensure that you get the unlimited gain in this particular situation. These were the 6 different situations if in case the prices are falling. Lastly, if in case the prices remains unchanged, so what's going to happen in case of this particular thing if in case the prices remain unchanged? Let's say 50 rupees is the spot price and 50 rupees is the strike price. Okay, now what's going to happen in case you are a call buyer? Okay, so if you're a call buyer, since you're a buyer, your loss will be limited to only rupees 1, which is your option premium that you paid. Since you're a buyer of this option, your loss is limited. If in case you're a put seller, again, since you're a seller, you'll be receiving the premium, that is rupees 1. That is the only gain that you'll be making out of this transaction, since the prices remain same at the last moment as well. So your gain will be limited. In case you are going for a long future position, okay, you bought something for rupees 50, you sold, and even today that particular transaction can be entered into this by paying the same amount, which is 50. So what was the gain that you made? You didn't make any kind of gain, neither you made any kind of gain nor you made any kind of loss. Now coming to this call seller part, if in case you are a seller and since the prices, spot price and strike price remains the same, since you're a seller, you'll be receiving some amount of premium, okay, which is your option premium, rupees 1. That is going to be your limited gain. In case of put buyer, since you're a buyer, again, your gain has to be very much limited. Your loss has to be limited. Since you're a buyer, so you need to pay your option premium. So your loss will be limited to your option premium that was paid by your end. That is going to be the limited loss. In case of shorting of your futures, again, you sold something for 50 rupees. Even today, that can be obtained from the market for 50. No gain or any kind of loss. Nothing. All these were different kind of positions. All these were different kind of market movements. And what will be your situation if in case you are a call buyer, put seller, long futures, call seller, put buyer or short futures? What should be done from your end if in case these 3 price movement happens? This is something which I have shared with you with my own knowledge relating to the market. Okay, that is something which will be helping you up in your development of your practical knowledge while tapping into the market. Okay, so tomorrow if you land up at any of your website relating to currency trading, so keep these things which I have shared with you, okay, in your mind, and definitely you're not going to be suffering any kind of losses relating to this particular segment. This is something which will be like immensely helpful for each one of you if in case you practically go ahead and take care of finance in your daily life. I hope that was clear to each one of you guys. Okay. So with this particular thing, I'll be like finishing up this particular presentation. It was lovely to have a wonderful audience like you guys. If in case you have got any kind of grievances, questions for me, if in case any other thing which you want me to share with you, do write to me on YouTube comment boxes. We love to have you over there. We love to discuss the kind of grievances that you are having. We love to have a conversation with you over there. Okay. So if in case you have found this particular video useful for you, knowledgeable, and is it worth sharing, definitely do share it with your guys. Like, share, and subscribe to our channel and our videos. And I'll be thankful to each one of you guys. So with this, I can simply say thank you on behalf of Edupedia World. Stay connected, guys, and keep interacting with me. That basically helps me up in immensely increasing my motivational booster for all of you guys, so that I can entertain you well with my videos. Like, share, and subscribe to our videos. I'll see you all in my next presentation with a lot many topics that are pending to be covered from our end. I'll see you there. Till then, take care. Sayonara. God bless you all. Bye.